Yeah, we were talking about EU sanctions on Russia. What's in the price? What does this do? What does this not do?
Yeah, I think this is largely expected. So what we've seen is the EU basically commit to turning down seaborne imports of Russian crude, but also allowing a carve-out for some of the Central European states like Hungary that are just so dependent on Russian oil, where the refineries really only have access to that pipeline supply. And so there will be an exemption, I think, for those states. So we'll still see some Russian crude flowing. But nevertheless, I mean, the trajectory for Russian crude supply is downwards. I think Russia's estimating an 18% reduction in crude supply through the year. So it's about 2 million barrels a day we're expecting over the course of this year in terms of a turn down in supply, which is very significant for the market.
Is that why, well, at least on this chart here, Brent is moving up? I mean, have we been expecting this, basically, is what we're trying to get to?
I think the market's obviously reacting to what we're seeing in terms of just supply and demand data, inventories that are coming through. And it's a tight market. Obviously, Russia is sending more of its crude into Asia, particularly India, into a lesser extent China. So it is making up for some of the declines in Europe. But, you know, we've got a European economy and a US economy where you're seeing this recovery post-COVID. I think really what's incredible about Brent at the moment is, you know, we're at $122 Brent at the moment, and China remains, you know, in partial lockdown. You know, if we see a reopening of the China economy, then I really think you'll see prices move significantly higher.
Yeah, that's what this sort of idea of a perfect storm, right? You've got falling inventories, you've got the start of summertime demand in the US and in Europe as well. And then if that demand destruction story in China kind of fades away, what's the ultimate upside here for prices?
Well, I think in the short term, I think we are going to see prices move higher. But you're right that the risk is that the higher we go, the greater the risk that we induce some sort of energy-led recession. If you look at the oil as a percentage of GDP, it's coming up to around 4.5% to 5% of GDP. And that's typically the level that you'll start to see demand destruction kick in. So I think the higher we go, the greater the risks you know, for the economy that will become almost self-fulfilling for oil in the sense that, you know, higher prices lead to, you know, weaker demand that will, you know, ultimately top out the cycle. But I think it's possible that we'd see Brent, you know, go as high as $150 a barrel.
We were just talking earlier about how almost all of the sanction flows from Russia are heading to Asia. If these new sanctions go through, is there a sufficient demand from Asian buyers to be able to absorb that?
You know, I think India is certainly showing a remarkable capacity to ramp up imports. I think China is being a little bit more cautious in terms of who is allowed to buy Russian crude. But I think the logistics of this are quite tricky. I mean, it takes about 90 days to send a tanker from, you know, the Russian ports through the Baltic and out into Asia. And I think certainly, you know, that could be a limiting factor. We've seen tanker rates significantly higher, and that could be a potential bottleneck to Russian exports.
Neil, what did we learn from this entire episode? Things like underinvestment. Do you expect a pickup in capex moving forward? That's not a very popular opinion, by the way.
Yeah. I mean, what we've learned is there's a massive risk premium now on oil as a result of Russia. I mean, Russia's just a huge supplier of energy to the world. If you restrict Russian energy flows, you've got to make it up from elsewhere. And that means moving higher up the cost curve, because remember, Russia's at the low end of the cost curve, but it means more investment. And what we're seeing at the moment is still investment running in the industry about $350 billion a year, almost half of what we saw in 2014 levels, because a lot of producers worried, you know, about peak demand, you know, decarbonisation, so reluctant to make the real long-term investments that are needed. And we're also looking at OPEC, which is sitting on, you know, maybe as low as 2% spare capacity. I mean, these are very low numbers, and as OPEC continues to ramp up production through to the end of the year, you'll see that spare capacity coming down. So it really is a very tight market with very little that's going to hold oil back other than demand coming down. And I think the only way demand comes down is some sort of energy-led recession, probably.
And I can't help but tie it back into what's happening this part of the world. I mean, you talked about, you know, sort of 90 days and all that thing. What if China recovers? And the hope, obviously, is China recovers. I mean, is there enough oil in the event that China does a U-turn?
Well, I think this is really would really light up the market because, you know, in 2Q we've seen jet fuel down, gasoline down very significantly in China. In fact, we're forecasting almost no growth out of China this year. Were China to reopen, I really think that would set a light under oil markets, and we'd see a significant move to the upside. Of course, the timing on that remains highly uncertain, as you know. But I think once China comes back, then I really think it will be a further leg up for commodity prices.